Something landed in my inbox 48 hours ago that I've been trying to verify ever since. And I'm going to be very direct about this. What I'm about to share with you is not public information yet. It's not being reported in the financial media. And the reason I'm covering it now before it breaks wide is because if what's in these documents is accurate, and I have reason to believe it is, the silver market you're watching right now at 84.88 is about to go through another structural shift. A whistleblower, someone who worked inside the COMEX clearing and settlement operations for over a decade, has leaked internal documents that show something I don't say lightly: the physical silver shortage that drove the price from $47 to $84 in 3 weeks is significantly worse than what the exchange has been publicly reporting. We're not talking about a 10% discrepancy. We're not talking about accounting errors. We're talking about a systematic misrepresentation of available physical inventory that, if these documents are legitimate, could mean the COMEX has been operating with fractional silver backing for years. And now that delivery demands have spiked, the truth is coming out. I'm going to walk you through exactly what these documents show, how I've cross-verified the claims against publicly available data, what this means for the current price at $84, and most importantly, what specific events you need to watch in the next 30 to 60 days that will tell us whether this is a genuine scandal or misinformation. Because here's the thing, if this is real, silver at $84 isn't expensive. It's early. Let's go. Before I get into the documents, let me set the context clearly because what's happening in the silver market right now is not normal, and these leaks explain why. Silver is currently trading at 84.88. 3 weeks ago, it was at $47. That move, as I covered in my previous video, was driven by a structural breakdown in the suppression mechanism that JP Morgan had been running for over a decade. But here's what's been bothering me and a lot of other people watching this market closely. The COMEX has published its registered inventory data every week for years. As of last week's report, registered silver, that's the metal available for immediate delivery against futures contracts, sits at 11.8 million ounces. Now, with open interest at around 180,000 contracts, that's 900 million ounces of paper claims against 11.8 million ounces of physical metal, a ratio of 76-1. The exchange has said publicly that this is not a problem, that most contracts are cash settled, that physical delivery is the exception, not the rule, and that the inventory levels, while low, are adequate for current demand. But here's the issue. Physical delivery requests in April hit 52% of open contracts. That's not the exception. That's the majority. And when you do the math, 52% of 180,000 contracts is 93,600 contracts. Times 5,000 ounces per contract, that's 468 million ounces of delivery demand. Against 11.8 million ounces of registered inventory, the COMEX has issued multiple delivery delay notices. They've raised margin requirements twice in 3 weeks. And premiums for immediate physical delivery outside the exchange system are now running 50% to 70% over the spot price. Something doesn't add up. And now, these leaked documents suggest what many of us suspected but couldn't prove. The inventory the COMEX has been reporting is not what it appears to be. There are 3 categories of materials in this leak: internal inventory reconciliation reports, email communications between COMEX risk management and major clearing members, and what appears to be an internal audit from late 2024 that was never made public. Let me break down the key revelations. Revelation 1, double counting of eligible inventory. According to the leaked reconciliation reports, the COMEX has been categorizing certain silver bars as eligible inventory, which means the metal is in COMEX vaults but not necessarily available for delivery. Eligible can be converted to registered if the owner allocates it, but it's not automatically deliverable. The documents show that a significant portion of the eligible inventory, specifically bars stored on behalf of ETFs like SLV and sovereign holders, has been double counted in internal risk calculations. Here's what that means. The COMEX's risk models, the systems they use to assess whether they have adequate metal to cover potential delivery obligations, have been treating eligible inventory as available backstop supply even when that metal is legally allocated to specific entities and cannot be delivered against futures contracts without those entities' consent. One email from a risk manager in March 2025, and I'm reading directly from the screenshot, eligible shows 140 men Oz, but practical convertible is closer to 40 mem. If delivery requests exceed 15%, we're in a forced cash settlement scenario. Let me repeat that. If delivery requests exceed 15%, we're in a forced cash settlement scenario. In April 2026, delivery requests hit 52%. Revelation 2, vault inventory discrepancies. The second major claim in these documents involves physical vault audits. According to the leaked audit report from November 2024, an internal review of 3 major COMEX-approved vaults found discrepancies between the reported bar counts and the physical bar counts. In 2 of the 3 vaults, the physical inventory was 8% to 12% lower than what the vault operators had reported to the exchange. The discrepancies were attributed to administrative errors, bar reallocation delays, and in one case, pending investigation. Now, 8% to 12% might not sound like a lot, but when you're talking about registered inventory that's already critically low, an 8% discrepancy is the difference between 11.8 million ounces and 10.8 million ounces. And if that discrepancy applies across the vault network, the real registered inventory could be closer to 9 million ounces, not the 11.8 million being reported. The audit report's conclusion, again, direct quote, immediate reconciliation required. Discrepancies of this magnitude create systemic delivery risk in a high-demand scenario. That audit was dated November 2024. It's now May 2026. And as far as I can tell from public filings, no reconciliation announcement was ever made. Revelation 3, forced cash settlements already happening. This is the most significant claim in the documents. Multiple emails from March and April 2026 between COMEX clearing operations and large institutional clearing members reference what they call negotiated settlements for contracts where physical delivery was requested but could not be fulfilled. One email from April 14, 2026, 2 weeks ago, client delivery requests for April exceed available registered by 340%. Approved emergency cash settlement protocol at spot plus 18%, legal reviewing force majeure language. Let me translate that. The COMEX could not deliver the silver that contract holders were legally entitled to receive. So they offered cash settlements at spot price plus an 18% premium to avoid default. Some contract holders accepted, others didn't. And for those who didn't, according to another email dated April 22nd, remaining unresolved delivery obligations total 14.7 miats OZ, awaiting executive committee decision on delivery extension versus default declaration. If this is accurate, the COMEX was, as of 2 weeks ago, facing the possibility of having to declare a default on 14.7 million ounces of silver delivery obligations. That's more than the entire reported registered inventory. Now, before we go further, I need to address the obvious question: how do I know these documents are real? The answer is, I don't know with absolute certainty. This is a leak, not an official disclosure. But I can tell you the steps I've taken to verify the claims and why I believe the probability that this is legitimate is high enough to report on. Verification 1. Document metadata and formatting. The documents are PDFs that include internal COMEX letterhead, employee ID redactions, and formatting consistent with other COMEX internal documents I've seen in regulatory filings over the years. The metadata, the technical information embedded in the PDF files, shows creation dates that align with the dates on the documents themselves. Could this be faked? Yes, but it would require sophisticated knowledge of COMEX's internal document systems. It's not something a random person could create in Photoshop. Verification 2. Cross-referencing with public data. Several claims in the documents can be checked against publicly available information. For example, the leaked email about delivery requests exceeding 15% triggering a forced cash settlement scenario aligns with publicly reported margin requirement increases that the COMEX implemented in early April, exactly when delivery requests spiked. The timeline matches, the response matches. That doesn't prove the email is real, but it's consistent with the behavior you'd expect if the email's claims were true. Similarly, the vault discrepancy percentages of 8% to 12% align with unexplained drops in reported eligible inventory that appeared in the weekly reports in December 2024 and January 2025. The exchange never explained those drops publicly. The leaked audit report provides a possible explanation. Verification 3. Industry source confirmation. I reached out to 2 contacts I have who work in precious metals trading and clearing, not at COMEX, but at firms that interact with COMEX regularly. I didn't share the documents, but I asked whether they'd heard anything about delivery issues or forced cash settlements in April. Both, independently, confirmed that there have been unusual settlement negotiations in recent weeks, and that several large institutions have been complaining privately about delivery delays and being pressured to accept cash instead of metal. One source used the exact phrase negotiated settlement, the same term used in the leaked emails. That's not proof the documents are real, but it's corroborating evidence that the claims in the documents match what people on the inside are experiencing. Verification 4. Legal and regulatory silence. Here's what's also telling. If these documents were completely fabricated, if this was a disinformation campaign, you would expect COMEX or CME Group to issue a public denial quickly. It's been 48 hours since these documents started circulating in certain trading communities. As of this recording, there has been no official statement from COMEX or CME Group addressing the claims. That silence is, in my view, significant. All right, let's assume for the sake of analysis that the core claims in these documents are accurate, that the COMEX has been overstating available inventory, that vault discrepancies exist, and that forced cash settlements have already occurred. What does that mean for the silver market right now? Implication 1. The COMEX is on the verge of a delivery default. If the exchange cannot fulfill physical delivery obligations and is already forcing cash settlements, it is functionally defaulting on its contracts even if it hasn't used that word officially. A futures exchange derives its credibility from the guarantee that contracts can be settled in physical delivery if requested. If that guarantee breaks, the exchange loses its role as the price discovery mechanism for the underlying asset. We may already be watching that happen in real time. The 50% to 70% premiums for physical silver outside the COMEX system are the market telling you that the COMEX price is no longer credible as a reflection of physical silver's value. Implication 2. The real available supply is lower than reported. If registered inventory is not 11.8 million ounces, but closer to 9 million after vault discrepancies, and if eligible inventory can't actually be converted at the scale the exchange's risk models assume, then the supply available to meet delivery demands is a fraction of what the public data suggests. In a market where delivery requests are running at 52% of open interest, that's a crisis-level mismatch. Implication 3, forced cash settlements create a two-tier market. If some contract holders are being forced to accept cash instead of metal, you now have a market where silver futures contracts no longer reliably convert to physical silver. That fundamentally changes the nature of the contract. It's no longer a silver futures contract. It's a cash-settled derivative with an embedded counterparty risk that the exchange might not deliver. And once that perception spreads, the institutional participants who use COMEX for hedging and price discovery will start looking for alternatives. That could mean a migration to physical markets, to offshore exchanges, or to private settlement arrangements that bypass COMEX entirely. Implication 4. The price has further to run. If the physical shortage is worse than publicly reported, if the COMEX's inventory is overstated and its delivery capacity is breaking, then the repricing we've already seen from $47 to $84 is not complete. Physical silver is genuinely scarce, and the price will continue to rise until one of two things happens. Either new supply comes to market at scale, or demand destruction occurs because industrial users can't afford the metal. Neither of those things has happened yet, which means the move that started in April is not finished. Let me get specific about what I'm watching over the next 30 to 60 days, because if these leaked documents are legitimate, there are very specific events that should happen as confirmation. Watch point 1, official COMEX statement or denial. If the documents are fake or the claims are materially false, COMEX will issue a public denial. They'll call it misinformation. They'll threaten legal action against whoever leaked it. If the documents are real but the exchange wants to contain the damage, they'll issue a statement that acknowledges administrative updates or inventory reconciliation processes without admitting to the severity of the problem. If there's continued silence beyond 72 hours, that's actually the most bearish signal for COMEX's credibility. Silence in the face of serious accusations suggests the accusations are harder to deny than to ignore. Watch point 2, changes to delivery rules or margin requirements. If COMEX is genuinely struggling with delivery obligations, they will change the rules to reduce physical delivery pressure. This could take the form of further margin requirement increases to make holding contracts more expensive, position limit reductions to prevent large-scale delivery requests, changes to the delivery process that introduce delays or additional requirements, emergency rule changes that allow for mandatory cash settlement under certain conditions. Any of these rule changes, especially if implemented on short notice, would confirm that the exchange is in crisis management mode. Watch point 3, registered inventory movements. If the vault discrepancies are real, we should see either a sudden adjustment to reported inventory numbers as they reconcile the audit findings, or we'll see registered inventory continue to drain at an accelerating rate as delivery demands outpace available supply. I'm watching the weekly inventory reports closely. If registered inventory drops below 8 million ounces, that's a red line level that would indicate the situation is deteriorating rapidly. Watch point 4, premium expansion for physical delivery. Right now, premiums for physical silver outside the COMEX system are 50% to 70% over spot. If the shortage is as severe as the documents suggest, those premiums should continue to widen. If we see premiums hit 80%, 100% or higher, that's the market telling you that COMEX pricing has completely decoupled from physical reality. Watch point 5, institutional migration away from COMEX. This is harder to track in real time, but watch for announcements from large commodity trading firms, mining companies, or institutional investors about moving their silver trading to alternative venues. If major participants start publicly stating they no longer trust COMEX for physical settlement, that's game over for the exchange's credibility. Watch point 6, legal or regulatory intervention. If the claims in these documents are true, regulatory bodies like the CFTC will have to respond. Either they investigate COMEX for misrepresenting inventory, or they intervene to prevent a systemic market failure. Watch for CFTC statements, emergency hearings, or investigations announced in the coming weeks. Any of those would confirm that the regulatory apparatus views this as a serious problem. Let me be very clear about the risks of acting on information from a leak, because this is not the same as acting on publicly verified data. Risk 1. The documents could be fake. Despite the verification steps I've taken, there's a non-zero probability that these documents are sophisticated disinformation created to manipulate the silver market. If they're fake and you make trading decisions based on them, you could be buying into a false narrative that collapses when COMEX issues a credible denial. Risk 2. The claims could be exaggerated. Even if the documents are real, the severity of the problem could be overstated. Vault discrepancies might be smaller than reported. Negotiated settlements might be routine rather than emergency measures. It's possible that the whistleblower had access to real documents, but interpreted them in a more alarming way than the full context would support. Risk 3. The situation could be resolved quickly. If COMEX finds additional silver to replenish registered inventory, if large holders convert eligible to registered, or if delivery demands drop as prices rise and some participants cash settle voluntarily, the crisis could stabilize faster than the documents suggest. In that scenario, the premium you're paying for silver at $84 based on shortage fears could evaporate if supply normalizes. Risk 4. Regulatory or exchange intervention could cap the upside. As I mentioned in my previous video, exchanges can change the rules mid-crisis. If the COMEX imposes mandatory cash settlement or position limits that prevent further delivery requests, the physical squeeze could be diffused artificially. That would likely cause the price to correct sharply even if the underlying shortage is real. Risk 5. You're buying at an elevated price based on unverified information. Silver at $84 is not silver at $47. If the leak is wrong or overblown and the market stabilizes, buying at this level could mean you're holding through a significant correction back to the 60s or even 50s. That's a real risk that needs to be factored into any decision you make. Let me close with where I stand on this and what I'm actually doing, because I don't want to spend 20 minutes on leaked documents without telling you how I'm thinking about them. First, on the documents themselves, I believe the probability that they're legitimate is higher than 50%, possibly significantly higher. The level of detail, the consistency with publicly observable behavior, the corroboration from industry sources, and the lack of an immediate denial from COMEX all point toward these being real. But I'm not treating them as verified fact. I'm treating them as high probability intelligence that fits within a broader structural thesis I already held. Here's what I already knew before these documents appeared. The COMEX registered inventory is at historic lows. Delivery requests have spiked to unprecedented levels. Physical premiums are extreme. The exchange has raised margin requirements and issued delivery delay notices. All of that is public and documented. The leak doesn't change that fundamental picture. What it does is provide a potential explanation for why the situation is playing out the way it is, and a framework for understanding how severe the problem might actually be. So what am I doing? I'm holding my physical silver position. I've held since 2023. I added in late 2025 after the JP Morgan settlement. I'm not selling at $84 based on a leaked document, and I wasn't selling at $84 before the leak either. The structural case for silver, physical shortage, industrial demand growth, suppression mechanism breakdown is intact whether these specific documents are real or not. But I'm also not chasing aggressively at this price. If you're asking me whether to buy silver at $84 based on a whistleblower leak, my answer is only if you were already planning to buy based on the fundamentals, and only if you can handle the volatility of being wrong about the leak's legitimacy. What I am doing is watching the 6 indicators I outlined very closely. If 3 or more of them confirm in the next 30 days, COMEX issues rule changes, inventory drops below 8 million, premiums widen past 80%, regulatory investigation announced, then the leak's core claims are likely accurate, and the situation is as severe as the documents suggest. In that scenario, $84 is not the top. It's a midpoint in a repricing that could take silver significantly higher as the market fully adjusts to the reality of a failed exchange and a genuine physical shortage. If instead we see a strong denial from COMEX, inventory stabilizes, premiums compress, and the story fades, then the leak was either fake or overblown, and the risk of a correction from current levels is elevated. I'm prepared for both scenarios. The one thing I'm not doing is ignoring this. Whether these documents are 100% accurate or not, they're shining a light on structural problems in the silver market that are real and documented. The COMEX is under stress. Physical silver is scarce. The paper market is losing credibility, and the price is repricing to reflect a reality that the exchange doesn't want to admit publicly. That's not a leak. That's observable fact. The documents just give us a window into how bad it might actually be behind the scenes. Watch the signals, stay disciplined, and be ready to update your view as more information comes out. This story is not over, it's just getting started. I'll see you in the next one.